Hi, Michael Yardney here, and this is a special recording for the attendees of Wealth Retreat because Andrew Mirams, one of my good friends and a close finance associate who's helped a lot of our clients and my family members, unfortunately isn't going to make it to Wealth Retreat this year because I changed the timing of Wealth Retreat without telling him, and he organised a holiday. So Andrew, I've actually grabbed you here instead to answer some of the questions attendees have put to me. Welcome.
Hi Michael, thank you. Yes, we didn't quite get our dates right, but as you say, we always talk about the 5 years and where will you be, and I for 5 or 6 years have told you I'll be playing the top 100 golf courses, and I actually will be this year, so I can say I'm actually living out what we talk about.
Fantastic, and that's great, and it shows that you've actually moved your life with your property investments and your business to the next level so you can take a long break, and I guess that's the aim of a lot of people watching this video. So Andrew, I sent an email to all the attendees and I got a list of questions and I'm going to run through those if I could, but there was a general theme. Obviously we're in what some would be calling a credit squeeze at the moment, and it all has to do with how the banks are perceiving our serviceability. So let's start with that. What's changed, Andrew? How are the banks looking at our serviceability differently?
It's a great question, Michael. It's one that's been coming up over and over again because people have been able to get access to credit, and probably quite easily in the past, where now there's a whole new level of inquiry that we have to go through. There's a whole range of things. So it hasn't just happened overnight. The first changes happened around about 3 years ago in April, May, June of 2015 was the first real impact, where what we saw was a lot of the lenders would actually service your loans at the actual rate. So if you had an interest-only loan at 4%, they would just take that repayment. Now, one of the key changes is if you've got a 30-year loan and you've got 5 years interest only, they amortise the loan now over 25 years, so the shorter term. And of course, now they buffer the rate. So in the days past, they did it at actual rate. Now they buffer the rate at an average rate of about 7.5%. So if you're paying around 4%, your serviceability in the first step was affected because they're almost working out on double the interest rate and at a shorter term. And that's where we've had a couple of conversations where it's almost gone full circle, whereas now if you're paying principal and interest because you're amortising over the longer term, we can actually get you access to more credit at times. So that was the first real change.
Well, that's interesting. We'll talk about the principal and interest in a moment. So what we're saying is that the banks are looking at your income, they're looking at your expenditure, and the income in many ways is your business, your rent, your job, but they're also looking at what your expenses are, and one of them is your interest, and they're suggesting that the interest rate is higher. They're stress testing you to make sure you can cope with a higher interest rate. But this is a challenge for many of the people watching this video. If you've got one property, it doesn't make a lot of difference. If you've got your own home, it's no big deal. But once you get a big portfolio, currently it's getting harder, isn't it? Because you've got so many more loans that ramp up.
Absolutely, yeah, because the more lending you have at the moment, if you double your interest rate on it and put that over a shorter time, if you just purely do the maths, people would say, yeah, well, if that actually happened, that would put us under a bit of stress. And that's what they're trying to achieve. So you're right with the income. There's been a lot more focus on the income sources and bonuses and overtime and things like that. So people earn money in a lot of varying different ways, and there's probably been a little bit of shading now on some of those income sources. But then the other thing you mentioned was not just the servicing, but now the living expenses and the stress testing around that. So we've seen, we had what we called a HEM, or a Henderson Index, which was basically 2 adults, 2 kids. It costs $3,000 a month to live. And that was that was the means with which everyone pretty much adopted people's living expenses. Now we've got to scrutinise this. A lot of the lenders are breaking it down into 13 to 15 different categories. You have to be able to validate that. We have to be able to say, if you put a 0 in one of those, why there's a 0. But so they're breaking it down in the analysis around your living expenses. We still have some clients that come in and say, I spend $3,000 a month, and they'll give us their bank statement, and you can see that the outgoings are about 5 or 6. And you go, well, clearly that's not the case. So, one of the great tips is being able to articulate and break down what it costs you to live per month, both from a basic measure. So, there are some things you just can't do without: food, utilities, things like that, and then a discretionary measure. So if you go out for dinner, that's fine. No one's judging that, but that is a discretionary expense. If you just get home, you've had a busy day at work, and you want to, go out for dinner rather than cooking, that's fine. But if you're under stress of losing properties or your home, are you going to still go out for dinner? No, probably not.
Now, Andrew, in the past, one bank was very different to the other. Sometimes you could get more at one bank, or they favoured a particular industry, or they favoured people who had rental properties. It seems that the range is narrowing and there isn't as much difference between the way banks are assessing your serviceability.
No, the band has certainly narrowed because they've all been pulled under the one APRA restrictions and the ASIC and all looking at it. So unfortunately, a bit like in old days where the interest rates just went up and down based on parts of the market, now they're regulating as well for the whole market, whether you're in a good period, say like Sydney and Melbourne have had, or not as good a period, say like your Darwins and Perth. And it doesn't matter. There's been a one size fits all. And yes, the difference between lenders is now a lot more narrow. There's still some niches within them. They still have different credit policies where some might be better with a self-employed client and some might look at overtime better and things like that. But where it was probably a far wider band, it's now a lot more narrow.
Now, some of the questions we've received from people writing in about this before Wealth Retreat was, what if I don't have a traditional job? What if I don't have a PAYE tax return, or I'm a self-employed person? How's that affecting me?
Open-ended question there, Michael. So, look, PAYG is the easiest. Self-employed clients, if you can validate and understand their income, they're actually quite easy. We specialise in that area. Needs a
specialist though, doesn't it? Most people won't get it.
Absolutely. Look, I'd say 75 to 80 maybe or more % of the banks and even brokers actually don't understand or are able to analyse and look at financials. I'm fortunate, I've been doing it all my working life pretty much, so it's very second nature to me. But there's lots of other sources. There's everyone's now a contractor or a consultant. That's a very normal means of work life now in the modern era. There's a lot of people on commissions and sales and bonuses. So you can still lend to those people. It's just the onus of proof. So if a commission or a bonus was guaranteed, as some people want to tell me, it would actually be your base salary. All right? Commissions and bonuses aren't guaranteed. All those sort of varying income sources, they're not guaranteed, and that's why we need proof. And probably now we need a longer term of proof, so we're looking at 12 months and even in some cases 2 years, depending on the industry. But there's ways around everything if you can validate it. So if someone's come out of 15 years of working in PAY and now they're contracting and they're earning, you can show their earnings at a similar rate, we can generally rely on that. It's being able to validate what the income source is. That's probably where there's been more scrutiny of recent times. But if you can validate it, we can generally work with it.
Well, that comes to another question saying, can I use my business income for refinancing a loan?
Absolutely, yeah. So it depends. Some people operate as a company, there's sole proprietors, there's partnerships, and then there's trusts. So as long as you can validate the income source, then absolutely you can use whatever your income is, your gross income. Doesn't matter whether it's earned in the business or earned by you personally, we can use it.
Now, one of the concepts we're going to be discussing at Wealth Retreat is owning properties in the right structure, and for many people that will include trusts, for others it'll be self-managed super funds. What are the bank's feelings about lending to properties owned in those sort of structures?
Yeah, good question. So two different questions within the question, because even a trust and a self-managed super fund are quite different. So let's do trust. So we're still lending to trusts every other day. Some of the more hybrid or derivatives with like the investor trust, where you have the loan in individual's name and the trust is the owner. The borrower is in the individual, and they're getting harder and harder to get through because the banks are looking for reasons. Anything outside the norm is now becoming more of a no than a yes. But lending to a trust it's just another entity. So as long as you can validate the income from the high level, then you can still lend to a trust. What it does is probably affects people's servicing capacity because you can't use the negative gearing against their personal income and things like that. So that's where it's becoming more difficult. And as we've already said, the scrutiny has never been, it's almost unprecedented as far as I'm concerned in 28, 29 years of lending, that the scrutiny we're going through at the moment is unimaginable in some cases. So as long as you can validate it, again, we can prove it. So lending to a trust is okay. Self-managed super fund, there's been a lot of scrutiny around these as well. And we've had lenders pull out of the market. There's only around three, maybe four lenders that we would actively use. And then their servicing calculators have tightened up quite dramatically. So you're now looking at basically a 70% loan to value ratio for a self-managed super fund, plus you've got to have 10% liquidity. So it's almost like a 60% loan to value ratio. And then you've got to meet the servicing requirements. So some people are making extra payments saying, look, I'm putting it in. Then you've got to do a complete servicing outside of the super. So it's become really, really complex, that area. But we're still doing loans to self-managed super funds. I think we've got half a dozen settling this month. So it's not that you can't get it. You've just maybe got to have more capital to start with before you can actually look at that. And there probably is, Michael, as you would always say, it's probably for more an astute investor, not a first timer and trying to get in with whatever super they've been able to squirrel away over their first 5 years of their working life.
Sure. Interestingly, a few weeks ago I was on Sky News Real Estate and they asked me a question, well, does that mean we shouldn't be going to mortgage brokers now with all the fuss made about mortgage brokers and mortgage brokers cheating the system? My answer to them was that in fact, like any industry, there are some rogues, but most are good professionals. And I think what you've just been saying to me is the reason why one does need to go to a mortgage broker, because it's become more difficult, it's become much harder to work through the maze. But then not any mortgage broker, I know I like calling you a finance strategist because you don't only think of this loan, but one or two steps ahead. So I'd like to ask you a couple of questions about the Royal Commission, because that has brought some interesting things have been highlighted. But how is that going to affect loans, the bank's ability to give loans, and the cost of money?
It's a great question. It's I don't call it a Royal Commission anymore. I've nicknamed it Banks Behaving Badly. So I think you've found that they've found a couple of sources in almost every industry. Look, it's fair to say in every industry, in every job across the world, there's people that don't do the right thing. So have there been some brokers? Absolutely, that have done the wrong thing. And don't worry, the professional brokers like myself, we want them out as quicker than they can find them. So that's no problems about that. What you've found is the banks, probably we had a weak scrutiny on brokers, and then the banks also opened themselves up, and I think it made us look pretty good at the end because
the banks had a much rougher time. There were many more interesting things going on in the banks than with the broking industry. You're right.
Well, they proved. I think what that did was prove even more so why you need a broker that has up to 30. Like we have 34 lenders on our panel. I'm not bound by one. I don't really mind who I go to. It's only the outcome for the client that I'm looking to achieve. So we have no direct affiliation with any one of them. We need them because they have something we all want, and that's money. There's more hurdles to jump over at the moment, but that's okay. Is it going to cost us more? Potentially. There's going to be more measures. I think when I started banking 30 years ago, people used to dress up in a suit, come into my office and actually have and there was probably a lot more trust in bankers and bank managers and also the banks at certain times. I think they've eroded that with their squeeze on costs, closing branches, everything's electronic if you hit the numbers. So I think they're a lot to blame, So if they get back to actually looking after their clients with a real focus on helping people rather than actually just getting to their bottom line, I think that'll help. So I think logically that might come at a cost. And unfortunately, not unfortunately, but it will get passed on to us.
So the cost is going to be that they are going to have to provide better service because there's no loyalty at the moment
Yeah.
to your bank because they're not loyal to you. There may be extra cost of scrutinising the loans or scrutinising the people because they're very allergic to risk at the moment. They don't want to take any risks or be seen to be doing the wrong thing. Is this going to affect some of the smaller banks? Are they going to have more difficulty meeting these new requirements?
Well, I think one of the things we've seen already, Michael, is that just to finish on that point, is that loan applications are taking longer because there is more scrutiny. So that what they haven't done at the moment is invested in more people to be able to monitor that. So we're seeing application times blow out a little because there's more scrutiny on that. Our smaller lenders have probably, of recent times, our second and third tiers and some of the non-banks, we use all of them. You know, we're not affiliated with any one in particular. We'll get the right outcome. We've seen some of their service times probably go out a day or two longer than what we would like to have. But that's because they're actually getting more inflows. The banks, as a rule, are saying no to more things. They're not really working within their, once upon a time they had a credit approval discretion. The discretion has almost been removed. You either meet the criteria or you don't. And that's seeing some of our smaller lenders actually become more popular and being able to do some things because a lot of them don't fall under the APRA umbrella. They still have to be careful and make sure they don't want to be sitting out, out there because they will get dragged in either by ASIC or APRA to, raked over the halls or over the coals, and we don't want that. But they're actually becoming more popular. They generally don't have the branch or the overhead network like the big banks do, and so they can often be a little bit cheaper. They'll often do something that the banks won't do, and that's where their real niches are still there. So like we said earlier, the band has narrowed, but there's still some great opportunities to still get finance. It's just a matter of who with.
So there's nothing wrong with going to a second or third tier lender or a non-bank lender. Are they still covered by the guarantees, the government guarantees? Well, that's really more for deposits, isn't it?
Correct, yes, it is.
They're not always deposit-taking institutions, are they?
No, so that's right. So the deposit, it's the ADIs, the deposit-taking institutions that are covered by APRA, and then ASIC monitor the other ones. So the non-banks that don't have full banking licenses that are monitored by ASIC. So an ASIC and APRA, we all know, are working together closely hand in hand to make sure that there's a regulated market. So they are looking at them and making sure they're not doing things that are outlandish. But we're still able to get some opportunities through some of those lenders that we may not get through the main banks now.
So if the bank says no, it's worth considering a non-bank lender.
If the bank says no, you shouldn't have gone to the bank direct. You should have come to a broker, Michael.
That's right.
Our job.
Excellent.
Yeah, but that's right. We've got to be fluid in our thinking as well. So we're talking to clients all the time about making sure you're just thinking it's about the outcome. It's not the banner on it is actually quite irrelevant. Which one gives you the money doesn't really matter as long as you get it under the right terms and with the right, rates or thereabouts.
Sure. Now, another question I've been asked, and it actually came from a couple of people, was if it's impossible to grow your portfolio at the moment because of serviceability, is it worth looking at more high yield properties or positive cash flow properties? I'm going to discuss that at Wealth Retreat because this is a short-term fix for what's a long-term issue of growing your wealth. But I do believe for a lot of the people at Wealth Retreat moving over to commercial property, as they're now going to be transitioning from the growth stage of their investment life to now transitioning to the lowering their loan to value ratio and getting more cash flow. So we will be spending a bit of time talking about commercial property. The loans for commercial properties, whether it's retail, industrial, warehouse, are very different, more onerous, lower loan to value ratios. But if you meet the serviceability criteria because you've got the high yield, it still works, Andrew.
Yeah, that's right. So you've covered off the key things. Generally a lower LVR than what you can get in residential. So an average of around about 65%. Yeah. Generally you'll pay higher fees and interest rates not that much higher, and there'll be a lesser loan term. So normally around the 15 years. Some will get out to 20 or 25 depending on the type of loan structure and loan arrangement. But you're right, for people that are actually in that position with a lower loan to value ratio getting into that type of lending structure and things like that can be. And again, the business banks, whilst they are all in one bank, business banking isn't regulated or are going through the same scrutiny, I guess, as what, with APRA and things like that. So they are all bound by similar rules, but sometimes business banking, business lending and commercial lending is viewed quite differently.
So just to explain, it's not a different bank, it's still the National Australia, Westpac or ANZ, it's a different division in the bank and it's a different form of loan called a commercial loan, which actually isn't always on a commercial property anyway. It has to do a bit with the size of the property. A block of apartments is a commercial loan as well. So that's again the reason why you can't just walk into the bank, because the average bank manager isn't going to get it, are they? Now to finish off, Andrew, you wrote a great blog a while ago, 10 lending tips to secure finance today. If we could quickly zoom through those, and then I'm going to suggest that people either go to Property Update and do a quick search on you, Andrew Mirams, and they can see this blog, or at your website at Intuitive Finance as well. But how do we grease the wheels of industry? How do we get these loans across today?
Yeah, look, so firstly, I think getting specialists on your side, so making sure people that work in and around those markets that you're looking to invest in. So dealing with Metropole, dealing with Intuitive Fund, people who are doing it every day, both from an advice point of view and also from doing it, literally doing it. Making sure you know what your living expenses are and you can justify them. Now, the breakdown and being able to articulate what you spend month on month is going to become more and more the norm. And people say, I've never had to do this before. And my answer to that often, Michael, is, yeah, but I used to be able to drive a car without a seatbelt and I could ride a bike without a helmet. Just because we didn't have to do it in the past doesn't mean we don't have to now. It's going to become the new rules. Considering principal and interest loans, so depending on where you're at in the stage, whether you're young and starting out or whether it's the difference between getting the money or not, principal and interest isn't the enemy, all right? So don't view it as that. We can always potentially, when things change down the track, we might be able to change. And same, interest only aren't that bad. So consider there might be an interest rate differential on interest only lending, but at the same time, whilst there is, it's still going to be better for your ongoing cash flow. So you need to consider both of those in conjunction, or just making sure you're not rate chasing and costing yourself from a capital point of view. But if you can afford it and it's the difference between securing a better asset, sometimes principal and interest is going to be the better ones. Making sure you're building your buffers. And so if you do have discretionary spending or you've got the ability to save, putting money in an offset, having an offset account firstly. I'm still staggered how many people don't know what it is or don't have one. Having an offset account and putting money in there just for a rainy day, I think is imperative. Obviously, buying the right properties, that's where the experts like yourselves come into play.
Well, the banks are going to lend more on certain sorts of properties and not lend as much or at all on others.
Yeah, absolutely. And when we do a strategy, it's about having buffers, and buying time is more important than buying property is important. So you need an asset to grow, but you need to give it the time to grow as well. So making sure your buffers are there. And right at the moment, whether you like it or not, you might get a no, and sometimes saying no or hearing no is the right thing. There's a no for a reason, that potentially you could be at risk. It's not nice to hear. We all want to continue to grow our portfolio, but that's just the sign of the times.
Sometimes the right thing to do is nothing and just wait. Yeah. Because people like buying a property every year. Doesn't work that way. You buy one and then you wait for things to go up and you to save some more money, and then you buy another one a couple of years later. Then there's another 2 or 3 or 4 years, and then you may buy 2. It's not like I'm going to buy 10 properties in 10 years or 7 properties in 7 minutes like they show on the front of the magazines, is it?
No, it's not. No, look, if it was that easy, we'd all be doing, and we'd have an island like Richard Branson that we could retire to every now and then. So no, it's not that easy. It's a process, and it's a long-term process. So. One of the things, though, still getting your properties revalued regularly. Now, not within a year if the markets haven't moved much, but still, I would encourage a formal bank, at least an appraisal by Metropole or a local real estate agent, but getting a bank valuation every 2 to 3 years is just sound, because it'll show you the equity you might be able to access subject to meeting the rules. I think getting bank valuations is still a great opportunity to see where your portfolio is.
Well, the part of the purpose of that, of course, Andrew, is to top up your buffers. So even if you can't buy something, if you've got the ability to increase that buffer to buy time, like you said a moment ago, because smart investors don't only buy properties, they buy time to ride through the cycles. This is a little bit of a downturn we're experiencing in Melbourne and Sydney, but if you were living in Perth, as some of our viewers are, there's been 44 months, 45 months now of falling prices. So those who had the right finance structures in place bought themselves the time to see through this, because the sun will shine again there.
Yeah, absolutely. It shines quite a lot. Just not on the property at the minute.
That's right.
And the final thing is having a plan in place, making sure you know. I think you articulate really well about having the GPS on, but if it's not in the right city, so making sure you know where you want to get to, and then having steps of the plan. Now you've got to be fluid in your thinking as well, when things like the restrictions on at the moment. So there'll be better times and there'll be harder. It's a bit like I explained, like a lung. It expands and contracts. There's going to be easier times, there's going to be harsher times. It's like every other cycle. It's just the way it's working.
Okay, fantastic. So thank you, Andrew, for spending the time answering the questions of those who are coming to Wealth Retreat. Sorry you're not going to be there, but you're living off your property portfolio and enjoying your life. Look forward to catching up with you on the Michael Yardney podcast and getting your blogs on Property Update.
Thank you, Michael. Enjoy, everyone.